How do you think about a rising debt trajectory and its potential impact on bonds? Who's buying treasuries, and how can an active manager both position and protect around some of these broader themes that we're talking about?
Sure. So we'll start with deficits. We do think the United States is in a unique position relative to other developed market countries in that we still are the global reserve currency. We still have this flight to quality dynamic to the United States and a confidence in U.S. institutions that allows us to be more irresponsible on the fiscal side than others. But with that said, these deficits are notable. They're higher than most other developed countries, and there's going to be practical limitations. In terms of impact, it's likely that our interest rates, our inflation-adjusted or real rates, are higher than they would be otherwise because of deficits. We expect yield curves to be steeper than they would be otherwise. And volatility will likely be higher as well. And over time, there are other areas of the world that will look more attractive in a relative sense. So although we've spent a lot of time analyzing these debt levels or deficits in historical context and are of the view that we have a bit more time here in this country, it's a risk and it's a concern. I think it's important to note that what may make sense over the longer term in terms of setting up the conditions for higher sustainable growth can be somewhat in conflict to the current environment where we have an economy that's still operating with inflation above central bank targets, where there's a tremendous amount of economic momentum, where labor markets are still relatively tight. This is going to be the tension. And the question, of course, will be, and we're focused very much on how the Trump administration is going to deal with this tension between longer-term goals and potential short-term concerns. And we saw a flavor of this in the initial reaction to the Trump win, if some of these policies lead to near-term inflationary pressure, the markets are going to tighten financial conditions on their own. And that very well could mean not only higher interest rates, but at some point some pressure on risk assets as well. To the extent that yields are going higher because of concerns around inflation, the Fed has said very, very clearly that they're going to react and respond if inflation does not get back to target or if it reaccelerates. And they're very, very focused on inflationary expectations. So it's going to be this tension that the administration is going to need to navigate. And we and the rest of the market are very, very focused in those areas. We do think deficits are going to remain elevated, and they're already high in a strong economy, which means if the economy were to weaken, they would likely go even higher. So what are we doing about that across portfolios? And we see attractive value in the bond market, but the U.S. isn't the only game in town. We've also been talking about a theme of diversifying our exposure across the globe. Other parts of the world, Australia, the United Kingdom, are high-quality markets, a better fiscal situation, arguably a less dynamic economy, and a little bit of economic weakness is usually good for fixed income performance, all else equal. And then even some higher quality areas of the emerging markets that have a significant yield advantage we think makes sense. Number two, we're concentrating the bulk of our interest rate exposure on the front end of the yield curve. We're a bit more hesitant to lend long term, both because we do think inflation will be a greater risk and we do think debt sustainability issues will remain in focus. So we'd like to concentrate our interest rate exposure in that 5 to 10 year part of the curve. And also we're not wildly overweight interest rate risk. We're back to neutral, and even some of our more flexible strategies, we're still running a pretty significant underweight. Then also, even though our base case view is that inflation will likely remain in that 2.5% type zone and even potentially trend lower over time, inflation protection is very, very attractive. Whether you're looking at Treasury inflation-protected securities or other types of fixed income inflation protection, or you're looking at commodity values in historical context. The cost to insure against inflation still is quite low. And across most of our diversified strategies, we have a pretty solid allocation or overweight to inflation-protected securities. Last but not least, liquidity or flexibility. We think this is an environment where running more liquidity, all else equal, provides flexibility in a world with more political uncertainty, especially on the debt side. We just think it makes a lot of sense to have flexibility to respond to what will likely be an environment of ongoing volatility. So those are the things that we're doing. It's a risk. We think it's a manageable risk. And in some sense, higher debt is not bad for the end investor because the U.S. government's forced to borrow at a higher yield. And of course, we and our clients are the beneficiaries of higher real rates than would be the case otherwise. Practical limits, sure, you don't want it to get too out of control, but we do think, again, this is partially why we're able to source, better value and still a pretty high quality segment of the fixed income markets.